We have three challenges for Bangladesh in terms of, on my side uh, uh, of the issues. The first challenge is stabilizing the external sector, which in itself is a major problem because the situation that we inherited, it had a higher balance of payment deficit in all categories. It had a declining reserve situation. Accumulated arrears were building up. In our estimate, it was measured to be $2.5 billion. So those are the external problems. We were facing import compression. We were facing also problems with our correspondent banks and LC confirmations and all those challenges. That's one set of problems. The second set of problem is a domestic problem, but it has its origin both from external and domestic sources, which is inflation. And the third problem is the banking sector and the big elephant in the room. Foreign currency areas, the LCs opened and that could not be settled, was estimated to be $2.5 billion plus. It is now a $300 million plus. Our objective is to reduce it to zero. We do not want to tolerate a single non-payment issue on account of LCs open. We wanted to make it very clear to our banking community that once an LC is open, no matter who has opened, it is the obligation of the banks, and the banks have to settle it. We have been settling LCs opened by Beximco, opened by Asylum Group. We are settling it now because they are not settling. So we have that problem also. It is the people don't exist, they are not here, but the liabilities are here. So we are sorting out those liabilities. So we are hopeful in a month or so it should become zero or virtually zero. Secondly, the central bank was selling reserves quite happily for the last 2 years, and our reserves was 48 billion. It came down to 20 billion. So there is no more luxury to spend dollars from our reserves. So we stopped from day one. I stopped selling any foreign currency for intervention in the foreign exchange market. Be it government import, be it private sector import, go to the interbank market, buy the dollar, settle your LCs. That policy is working. And I must say that we have also, it did not create too much pressure on the exchange market. For that, I will give credit to our remitters because our remittance is 26% plus higher than last year for the last 5 months, almost halfway through the fiscal year. So that's a significant, I would say, almost $3 billion, more than $3 billion additional resources we got from revenue side in this last 5 months. So that helps the market. Exports had a lot of problem. We know that industrial unrest, delays, power shortage, all kinds of structural issues which have been hampering our export performance. But despite all that, the export of the last 5 months is about 10%. So that also helps. We are hopeful that the trend we are seeing as of now is going to continue in the months to come. The current account is now, from a large deficit, is now a virtual balance. The financial account, which was a deficit of 1.7 or something about that, is now a surplus of about 900 million. So a swing of more than $2.5 billion in financial account flows. So that's also reflected in the overall balance. So what I'm saying is that, if you ask me, do you have a balance of payment problem, external sector problem? I would say it's already managed. There is no crisis that I foresee on the external front as of now. Commodity prices are good. Exchange market, if we talk about, exchange rate is fairly stable. Even if it moves by 1 or 2 taka, it doesn't make much of a difference. What I'm trying to underline is that stability of the exchange rate is our objective, and we have also achieved that. We want to maintain that. In support of that, we have tightened the monetary policy very significantly. And monetary policy, the return on taka asset is now much higher than the return on dollar assets. It's reflected in the market. We have bankers here. The bankers used to keep extra dollar in their nostro accounts. They have reduced it. Why? Because keeping dollar is not rewarding. Keeping taka is more rewarding. Plain and simple. So they have reduced their nostro account balance and buying taka to settle their payments and make their payments, etc., etc. So that's what we want to see, that you move out of your dollar holding and move to taka asset, which is giving you much more better return than dollar assets. And the exchange rate stability is helping that transition process. So that's about the external sector. All the policies are in place. The monetary policy is sufficiently tight. Central bank has not given a single taka by printing money to the government. Not a single taka. Actually, central bank, the government has actually sterilized some of the money from the government. The treasury bills, the central bank bills have been paid, and the government is borrowing from the money market. So that's what we want. And as a result, I think that policies to bring down inflation is in place. Monetary policy is very tight. Fiscal policy, they are cutting expenditures, trying to keep domestic borrowing of the budget to a reasonable level. Still not the level I would like to see, but much below what was stipulated in the budget. Third, on the supply side, there had been problems. Because of the flood in October, August, September, and October, there's a flood, and there was also a protracted rainy season. Because of the very long rainy season, the crops like onion, like potatoes, and the winter vegetables could not come to the market in their normal time. It has been delayed by 1 to 2 months. And that 1 to 2 months is the time that we are waiting. I can tell you there will be a good crop of onion, there will be a good crop of potatoes, and it will be coming down to 30 taka, 40 taka, 35 taka. But it's only about 2 more months. We have to allow that. We cannot just pull out the potatoes which is not even matured now. Some people are doing it because they're getting so good price that even the fully grown onion will not bring the price which you will be getting now. So that is happening, which is a cannibalization. I don't want it because it reduces the ultimate output. But the bottom line is that farmers know that the prices are going to come down. And we know that it is going to come down. So let's give it the time that we need to do. We have reviewed all the countries in the world, or that basically the lesson that we get is from the US, UK, European Union, or Thailand and other countries, is that it will take at least 12 months to 1 year for the full impact of inflation tightening measures to be reflected in the inflation target. So we have to allow that time. I think all the medications that could be applied has been applied. We are waiting for the body to react to the medication. That means we are waiting for the economy to react to the doses of economic policy tightening. So on the supply side, we eliminated the government has eliminated all the import duties on essential food products. It's not zero. There is no import duty on onion, on vegetable oil, on sugar, or on any of those basic items. All zero. In order to make the prices little bit more tolerable for the consumers. Let me assure one more thing. Once we get the data for January, if that data does not show a decline in inflation, we have to tighten the monetary policy further, because we need to do whatever needs to be done. That's the philosophy. I don't believe that we know perfectly the outcome, perfectly the turning point. We have to read the data, analyze the data points, and decide on that basis. I still believe the level of policy rate at 10% and lending rate around 14% or so is probably, we have seen the peak. But if that presumption is not borne out by the data points that which will be coming in the month of for December data and January data, then I have to revise my own prints and have to go for tighter monetary stance to make it happen. It has to happen. So that's the objective. My target is to reduce inflation to 7% by end of June and to less than 5% in the next fiscal year. So this is our objective, and let's see how it plays out in real life. The third issue is a more protracted, bigger issue, which is the bank resolution issue. We know that, you probably all know that so much resources have been drained out of the banking system in a very systematic manner and in a pathetically by state-sponsored manner. And now we have banks where 87% of loans have been given to one family or their shadow representatives. 87%. And this is not one bank, several. If that 1% is not in the country and all the money is out of the country, how do you solve that equation? It's almost impossible. So we are thinking of, we already drafted a Bank Resolution Act under which central bank will be given the authority to undertake decisive measures, including liquidation, merger, injection of new capital, and all type of options. We have given some liquidity support to 6 banks. We are waiting for the result. If this can survive with that support, it's good for those banks, good for us, good for everybody. We hope the depositors will also understand that they need to stay with the bank to support the bank. And without the support of the depositors, we cannot pull it off. So I always urge in every occasion that depositors must have faith. They will be fully compensated no matter what. So they should stick to their institution, financial institution, where they have put their money and not rush to those institutions to take their money out. Then there is no solution. Everybody will be worse off. So we will urge again the depositors to be patient. The government is on their side. They will be fully protected. We hope some of the banks will survive, come out of it slowly but surely. If you look at Islamic Bank, for example, the largest of these troubled banks, it has already come out of the liquidity crunch. Every day, Islamic Bank is getting 600 million taka surplus between withdrawal and deposits. That means their deposits are 600 million taka more than their withdrawals. That means they are out. They can survive. They have the oxygen to keep going. So our tasks become easier with that. Same thing with few other banks. They are now on the verge of what I call graduating from the liquidity situation. They can sustain it on their own. But some banks will remain in questionable form, and we may have to take very decisive actions, and we are ready for it. We are discussing we have started the asset quality review. The firms have been hired. They are in Dhaka, and they're getting the methodology and everything worked out. From January first week, they will start the actual bank by bank inspection and review of asset quality. So we can identify how big is the problem for those banks and who has taken the money, how they have taken the money, and how we can link it to something what you called evidence gathered with a view to take them to task. So this is on. This process is being followed in a very systematic way. We have been in touch with US Treasury. We have been in touch with the British government. We have been in touch with World Bank Star Group for Asset Recovery Program. We have been in touch with the European Asset Recovery Program. We are getting excellent support from all of those agencies. The US Treasury has visited us already twice, and they will be coming back again in January. So we hope that we will get the international support, political support for our worthy cause, for recovering the money and repatriating it, however long it takes, following the due legal process in their respective territories. There is no good news that's coming in the next 2-3 months or 4 months. It will only be increasing, perhaps until the end of the fiscal year, when all the chips will fall. By that time, new regulation is also coming into effect from end of March. So from beginning of May, the time period for non-payment will be shortened to 1 month. So with everything happening, we will be expecting a very rapid increase in NPL ratio in the coming months. In my personal view, it may reach up to 30%. Like Jamuna Bridge, for example. Further bridge may not be still there, but will be there in future once more traffic is there. Jamuna Bridge is highly profitable, and the traffic growth has been phenomenal, and it has exceeded the original projections and so on. It is a ready one for taking it to the market. So government has to think of it more, I would say, creative way. We have to generate supply in the market. We also have to create demand in the market. That means the pension funds, the gratuities, all those things need to be fully funded. Actuarially assistant fully funded, and those needs to be invested properly, not only in government bonds but also in private bonds, and some kind of investment guidelines, etc., prepared at the corporate level to allocate those resources, so that we create both the supply side of it and also on the demand side. I've been urging the government that move quickly on this government pension plan as a fully funded pension plan. If you can move that into a fully funded system, you generate resources, and every year there will be thousands of crores of taka accumulated, and you can use that resource to fund your long-term plans, long-term projects, and so on and so forth. So we have to go beyond the traditional ways of managing pension system, creating supply of resources from those institutions. Pension fund, for example, then insurance sector is in shambles. If we have a healthy insurance sector, that could be a contributor to the bond market development. So with all of these key components of the financial system needs to work together for the bond market to develop. Of course, government bond market must play the leading role, and it is still not fully there. We do not have a liquid, long maturity government bond market. It is illiquid. There has been some issuance, but they are all locked up because return is very high, and nobody wants to sell. There is no liquidity in the market. So we need to create more liquidity. One easy way is to transform all of the national savings certificates into bond. That way you can inject 5 lakh crore taka, that means 5 trillion taka of bonds into the market, and you create a vibrant market. So I think our counterparts in finance and other places need to think much more creatively to bring about the changes in the legal framework, in the market development, so that we really have a vibrant bond market. Start with 5-year maturity, go to the 7, then 10, then 15, and so on. It is not going to happen overnight, a 30-year or 40-year bond market in Bangladesh. That's not there. So we have to work diligently, but surely in a very structured way to achieve those diversification of sources of funding.